All right, good afternoon and welcome everyone to our Graziadio family, friends, students, and guests. Thank you for joining us today. I want to thank Graziadio Alumni Network and Graziadio Board Real Estate Committee for making this leading edge conversations possible. Today's leading edge conversations topic is the future of real estate. And I want to introduce to you first our moderator for today's event. Our friend Charles Bassett, who is part of our Graziadio Board. He's an alum of our school, and he's also part of our Board Real Estate Committee. And he's currently the President of Operations for LNR Group of Companies, and he will be moderating today's talk. So let's give him a big welcome, and I want to hand this over to Charles. So Charles, this is all yours now.
Thanks, Abraham. Good afternoon. I'm Charles Bassett, a proud graduate of the Pepperdine Graziadio Business School. I currently have the honor of serving on the Graziadio Board under the outstanding leadership of Dean Derek Van Rensburg. I also would like to acknowledge Dr. Lily Bernice Ledbetter, Dean of Student Affairs and Alumni Affairs. On behalf of the Pepperdine University Alumni Association and the Graziadio Board Real Estate Committee, on behalf of the Pepperdine University Alumni Association and Graziadio Board Real Estate Committee, we thank you for joining us today, as we are excited to offer you this engaging and informative session. It is my pleasure to moderate today's leading edge conversation on the future of real estate. I encourage you to take notes and prepare any questions that you would like the panel to address at the end of the session. Please submit your questions through the Zoom Q&A feature. Your questions will be moderated by Jason Stubbers, Associate Director of Alumni Engagement, and Christine Zhu, a current grad from the Graziadio Master of Science and Real Estate program. As we all know, the impact of COVID-19 has been devastating on the global economy and the way we do business. With so much uncertainty on the new norm, we bring you 4 expert panelists that have a wealth of knowledge in various areas of real estate. We thank each of them for taking time out of their busy schedule to share their perspective on what the future holds. In the essence of time, I would introduce each member of the panel by name and ask them to give a brief overview of their company and professional background. So with that, Paul Hamilton.
Well, thanks, Charles. I also graduated from Pepperdine with my MBA, so proud graduate as well. I started a company called Province Advisors 12 years ago. We're now one of the leading boutique bankruptcy and real estate firms in the country. I also am the CEO of the Greensmine Corporation in American Nevada. At one point a year and a half ago, we were managing about $3 billion worth of our own property.
Great, thanks, Paul. Larry Cosmont.
Hi, good afternoon. Larry Cosmont, President and CEO of Cosmont Companies. We have been in business for over 30 years, and we focus on 3 areas of expertise: economic development, real estate, and public finance. We are a leading firm in the endeavor of public-private partnerships and real estate transactions involving private sector investment and public finance. And we have clients all over the country, but primarily in California, many counties, cities, as well as private developers. We've recently been focusing on creating brand new tax increment districts called enhanced infrastructure financing districts. We have about 30 going on around the state, and we're the leader in that marketplace.
Great, thanks, Larry. Okay, Paul Martinkovic.
Got to remember to unmute. Hi, I'm Paul Martinkovic. I'm CEO of the Journey Partnership. We're an architectural urban planning company, 43-year-old company. I've been with the company 30 years. I thought I'd only be there a couple years and stayed 30. We have about 200 million square feet built globally, 120 places built in 75 cities, and about 1 billion people visit our projects each year. Some of the projects we've done that you might know are Horton Plaza, Universal City Walk, the Palms in Las Vegas, Bellagio in Las Vegas, and we've done a number of projects, and very famous projects in Asia and all over the world for that matter.
Thanks, Bob. Thank you for joining us. And Adam Henderson.
Thank you, Charles. And it's a sincere pleasure to be here with all of you and all of those in the audience. And I'd like to just shout out to Christian O and let him know I appreciate his engagement and introducing us to, I've always admired Pepperdine University and happy to be here today. I'm president and CEO of Sleepy Hollow Investment Company. We're a multi-asset commercial real estate company and also in other projects, wineries and such, but office buildings, industrial, multifamily, and medical. And then I'm also Chief Operating Officer and Head of Global for Keiretsu Forum, which is the largest early stage angel investment network in the globe. We have 53 chapters around the world and in 24 countries. So I'm happy to be here today and looking forward to the discussion.
Thanks. Thank you, Adam. Okay, let's get started with our moderated session. So Paul Martinkovic, this question is for you. With your experience designing world-class development projects and complexes, what kind of impact are you seeing from COVID-19 on current and finalized design concepts? And how do you see designs changing for the long term as we eventually roll out of this pandemic?
Sure. Well, the COVID-19 was really an accelerator of a lot of changes that were in the process of happening. You know, the profession now pretty much demands you use BIM programs, which are, you know, it's a program that basically consolidates all the design intent, building costs, that type of thing that the owner eventually uses to efficiently run their building. The architecture profession has changed a lot in the last 5 years. I mean, basically, clients are looking for more soft programming ideas on how they can make their product more differentiated. So it's not necessarily a physical space problem. It becomes like a programming problem. Life cycle of projects has diminished quite a bit. I mean, once, when I started in this industry, a 30-year life cycle was something. Now could be even 5 or 10. Because it's changing so much. We're also starting to use artificial intelligence to do design, and certainly anything that can help the owner reduce costs, receive their LEED certification, and that sort of thing is something that's forced the industry to change.
Great, thank you, Paul. Okay, this question's for Larry Cosmon. Given your extensive background in city management, what does economic development look like in Los Angeles?
Well, it's, we're in a COVID economy, so economic development really spells recovery. We are at Cosmont, we've done a presentation for over 1,000 public officials in the last couple of months, which is called Resetting the Economic Development Table in a Post-COVID Economy. And the reason is that you have an abundance of communities in California and in LA that have been chasing hotel and sales tax for 20 years. I mean, they used redevelopment to engender retail development. We're over-retailed in this country anyway. We're the most retailed country in the world. And then you add on the advent of digital economy and then put COVID as an overlay, and you have some real collapsing features in local economies. And so really economic development is about using the best tools that you can use to reposition your economy as quickly as possible, even though you're really not in control of that. You've got to follow private sector investment and help save what you have and induce what you can. Let me just close by saying that it's astonishing. I'll just give you some figures. Places like Monterey, 36% of their budget is TOT. Sand City, 84% of their budget is sales tax. I mean, there are lots of examples. Anaheim, 47% TOT. Not surprising. It's just that these local economies have to reposition quickly, and that means engaging in public-private partnerships, working with the private sector, and using their zoning as capital. In other words, we call zoning equals currency for cities. They don't have money to spend. But if I give a developer residential zoning that's now retail, I've just changed the economic equation of the residual land use and the ability to borrow. So these are the kinds of tools we're bringing into communities, and it's a much different phase. Before it was about economic development strategies. Right now it's about saving projects and encouraging investment in an adverse environment.
Okay, great. Thanks, Larry. Larry, in question, as a follow-up question, so the infrastructure development that's taking place throughout the county of Los Angeles, you have Los Angeles Road Airport spending over $14 billion on capital projects, and you have Metro, which has extensively expanded their line. What does that look like for developers? I always hear that, you know, there's opportunities next to the train stations, and when infrastructure comes in, it motivates.
Yeah, I mean, infrastructure, I think, is, you know, creates a playing field for investment. And that's the good thing about infrastructure. It takes a long time to get it done. It's expensive to capitalize. The politics behind delivering major infrastructure projects are not easy, as we know, particularly in Los Angeles. It's a full contact sport, right? But once you get past that, when you can predict infrastructure investment on a focused basis, then the sites adjacent to that investment, particularly if it's utility investment or capacity investment like roadways or transit, though you can, as a private sector, you can follow the infrastructure dollar, but the dollar can only be leveraged if the community provides zoning and approvals and entitlements that are compatible with the infrastructure that's being introduced and implemented. So it's a two-step process. Infrastructure can lead to investment opportunity, but it's only opportunity if you can close the door on some very good entitlements to capture the added value that the infrastructure sets the stage for.
Great, thanks, Larry. Okay, Paul Hamilton, this question's for you. With so many businesses going under and filing bankruptcy, how is Providence helping business and commercial real estate owners during this current crisis?
Okay, there I am. So many of our clients are like, we just got Guitar Center, for instance, the bankruptcy around Guitar Center. And, you know, what we all know is first is employees in terms of cost, and then there's real estate. And with the move to online that has been taking place for the last 20 years, but has really started to escalate quickly now. I mean, Paul hit on it earlier when he said that COVID didn't really change the outcome of a lot of the things that were going on with companies, et cetera. It just sort of accelerated what was happening in a way that we haven't seen before. You know, unemployment numbers, you know, 33 million last I looked. It took the recession in 08, 09, it took, I think it was almost a year and a half to start hitting numbers like that. So everything's just happening in hyper speed. So one of the things that we're doing is, you know, we're meeting with our clients that maybe their business model needs a change and they have a way out. They have a product line that's coming, that's starting to surge a little bit. Like an example would be of just a business, not necessarily a client. If you look at the way that Petco evolved as like this, you know, bricks and mortar, you know, 30,000 foot box, but then Chewy came out and their online product is crushing it. And the, you know, as we all know, the sort of bricks and mortar, as Larry said earlier, we're so overbuilt in retail, just as a general rule, that, you know, what we're doing with our clients now, if they're not already in total distress, is talking to them about, this is a moment in time to cure your ills, because the lenders are willing to listen right now. And this is a time to try to fix what ails you before you completely fail, if you have something to land on. Now, if you have a business that has not evolved, and again, Paul touched on this earlier, that, you know, in the old days, if you had a newspaper or a train station or something like that, it lasted 100 years of money, generations made off of it. Now, you have a brilliant idea, you may have 5 years with it before you get hit over the head. So our goal is just to try to help our clients continue to evolve as businesses and, you know, help them segue out of the stuff that's killing them.
Thanks, Paul. Okay, this question is for Adam Henderson. Adam, COVID has created a whole new world of workspace, work from home workspace. What is the future of office buildings and office space?
Wow, well, that's a big question, and it's funny. I get that question a lot these days. You know, what is the future of office space? Because the simple logic says, you know, look around. You know, this drawn out pandemic work from home experiment. You know, is everybody wondering when employees will return to physical workplaces? But I think the truth of it is, you know, office space is not dead. It's going to look very different in the post-COVID world. You know, and a number of things sort of support the idea that it's going to be very different, but it's going to be here. And it's not to say there isn't going to be, you know, real estate's very local and micro. So there's going to be problem areas, and there's going to be other areas that are going to do fine. And a lot of that has to do with what Larry's talking about too, is how these cities adapt and get their ship righted. And I'm up here in the San Francisco Bay Area, and you know, we're one of the ultimate experiments. But if you look around and you pay attention to what's, you know, going on, the big boys, you know, the Googles, the Facebooks, Amazons, they are now eminently a part of the real estate landscape, and they're signaling that office space is going to be around, and they're going to be here. You know, Facebook signed a huge office lease in Manhattan at Penn Station. They also bought REI's headquarters up in Seattle. We've had large announcements from Google. They're moving ahead with 1.3 million square feet of development on Landings Drive and Mountain View. So these are signals to us that you know, those are large employers. They're big employers, and they're continuing to look at their office space needs going forward. You know, the other thing is that some companies are realizing. I don't, you know, Reed Hastings, CEO of Netflix, you know, he's commented in the Wall Street Journal that, you know, working this remote work thing is a pure negative, and others see it, you know, another way. But if CEOs are speaking that way, it's gonna, you know, it's gonna get people back to work. And, you know, other executives are rethinking, you know, this remote thing isn't so great. Collaboration is harder. Training new workers is a struggle. You know, projects take longer. And so I think the future of office space is really here to stay, just going to look different. And then as we look forward, it's going to be the adjustment of those buildings to new technologies and adjusting to the COVID environment, which we can go into more. But it's going to be here. It's just going to look very, very different. And some are going to have windfalls, and of course, others are going to struggle who have older, obsolete office buildings.
Great. So my company actually purchased several office buildings over the previous years, and we sold 3 office buildings at LAX to hotel developers that converted the office buildings to hotels. We also sold an office building in downtown Los Angeles on 6th and Spring Street to a developer who converted it to condominiums. Do you see that trend continuing?
Well, yes, I do. I mean, and this, you know, probably, you know, Larry's seen it with jurisdictions. I mean, cities, counties, and we're all going to have to get actually creative about how we use buildings. And in fact, it's almost certain a number of office buildings in the Bay Area are going to convert to housing. And that's going to be the higher and best use for those in the future. And there's a lot of creative people out there. You know, there's a lot of money in the market looking at these opportunities, and the landscape's changing. I mean, I'm seeing a lot of people are asking me about self-storage and you know, that sector in of itself, which is kind of a quiet little sector, but it's doing very well. If you have storage areas for RVs and, you know, boat toys and things like that. So it's going to be a continued reuse thing. And in fact, there was a deal done in downtown San Jose for a 15-story office building that was a $131 million deal right in the middle of this COVID in late June. And so we see the players are going to be out there, and that's going to be a reuse type property.
Oh, great. Thank you, Paul. Adam, thanks again. And the next question is going to be for Paul Martinkovic. Social distancing restrictions have had a profound impact on indoor space. What is the future of malls, and what does retail look like post-COVID-19?
Well, as we know, the malls are in trouble before COVID-19. There's over 1,000 malls in the U.S., sort of A, B, or C category, and they're broken down about a third, a third, a third. So a third of the malls in the U.S. will go out of business in the next 1 or 2 years. The good news is that most of those properties are in very good locations. So the malls will become, I mean, as you know, there was a move towards densification in urban areas, but I think with COVID-19, people will be more demanding of the suburbs. So, you know, those malls that are in the suburbs will go through an adaptive reuse, and the mall will become an amenity to the residents around it. So we have a project in Huntington Beach called Pacific City. It doesn't have an anchor. It doesn't have cinema. It's mostly food and beverage. The average spent time in that mall, in that project, is 4 hours, which is a lot. So you're getting people to spend money. There's a project we just opened in Costa Rica called Oxyhino, and the owner spent quite a bit of money creating a public park. And, you know, instead of having tenants, they've spent a lot of money as using advertising as a tenant. And the big esports thing, they generate a lot of revenue with that. So there's a lot of opportunity. You know, retail was in trouble. I mean, I think Paul mentioned the leverage buyouts where companies, you know, incurred a lot of debt, but they didn't invest in technology. Technology for retail is going to be the huge value add. Companies like Best Buy, you know, they're still going to have physical locations, but they have the ability to order things or, you know, view things online and then, you know, connect with a sales associate in the store to sort of view what you want to buy. So I see a lot of opportunity, but it's going to be different. And the technology is the operative. I mean, that's the value added. That's where retail companies will succeed.
Thanks, Paul. It's funny you say that because one of my properties in Atlanta, we have a parking lot that Walmart has interest in, and they actually want to put a pilot program on in which they'll be delivering items to consumers by drone. So we're actually exploring that opportunity. So technology definitely is playing a big part in the retail industry. Okay, Larry Cosmont, this question's for you. To attract business, how can city managers ensure local regulations do not inadvertently impede or constrain real estate development and economic activities? And what tools can they use to entice investors and entrepreneurs?
I'd like to answer this a different way because I want to piggyback on what Paul said because it's very meaningful. This stat of 1,000 regional centers. In California, we have 502 cities. Half of them have regional centers that are anchored with things like JCPenney, Macy's, and so on. I mean, what happened in COVID was that the inside of the mall gets gutted. The outside of the mall had already been impaled. And so all of the anchors that cities were using to attract economic development through retail sales taxes are essentially gone for them. Retail is not a leading program anymore. So to your point about attracting economic development and doing the kinds of things that can move your local economy forward, what I'm here to say to everyone is that there is a once in a lifetime opportunity now to reimagine retail and reinvent these regional centers. And firms like Paul's, the Jurdy firm, which is an extraordinary firm, can lead the effort in design and what I call blended use, not mixed use, but blended use. What really happens is you have large properties that are covered with cross easements embedded by anchors that once dictated how the project was going to operate, how it was going to develop. What cities need to do is create special districts that allow them to vacate the easements and use tax increment and overlay zoning that emphasizes creative office, as in Paul's case, a reduced level of active retail with food, creating districts that are blended use districts that compensate for the loss of retail by the increase in trips to the center, whether the trips are generated on site or because there are services there that require people to go, as opposed to accomplishing what they need to on a screen. Trips versus square footage. Trips per sale are really the key. Square footage is really not the issue anymore when it comes to retail. And so the point is those city managers have to first convince their city councils, and this is what we're trying to work on at Cosmont. We're going up and down the state. We have, 80 public agency clients, but with the League of California Cities, with CalEd, with all of the leadership groups, putting on presentations that show this reimagining of a retail center is a restart of an economy in a COVID world, and picking land uses like higher density residential, creative office, and placing them strategically next to each other with a lot of open space and a lot of active environment, whether it's retail, restaurant, or entertainment, or education, or services, is really the new equation. And that's not how we built out California. We built out California with long roads and big shopping centers anchored by 3 big boxes and a bunch of space in the middle. And now we've got to retrofit that. That's the opportunity for local economies to really make that work. They have to relook at their zoning, look at residential as a priority and an opportunity. In a residential world, in a COVID world, we're buying on this. We're not going to a store. So a residential unit is a generator of taxes, but the fiscal models that we use don't demonstrate residential as being accretive. So there's a local bias against residential. So this whole mantra of blended use, mixed zoning, adjacency, active uses that generate trips is how local city managers and planning directors will be able to revive their local economies. And that's going to need to be their emphasis going forward. That's the key opportunity.
Great, thanks, Larry. Larry, quick question for you. There's the buzzword opportunity zones. Can you touch on those?
Sure. So opportunity zones, we have about 800 plus in California. It's the largest contingent of opportunity zones in the country. They were created a couple of years ago through a federal act that basically enables investors to take their capital gains from any sale of a property or a business. Unlike a 1031, it doesn't have to be a like-kind property. It can be a business, it can be stock sale. Move them to an investment in those declared opportunity zones and essentially freeze their capital gains treatment at the front end, and also escape capital gains at the back end as long as they hold that investment for 10 years. You know, the problem with that is there are time frames in which you have to invest in order to be eligible. And in California, where zoning and entitlements take a long time, that has been a challenge. However, because of COVID, some of those time frames have been extended. But also, because California really doesn't treat the capital gains exemption in OZ zones under the California tax code. In other words, it hasn't matched that. All of the California investors have sort of a 13% penalty as opposed to a place like Texas or elsewhere. So what we're trying to do now is for those 879 cities that have opportunity zones is to, one, work with the legislature to forgive some of that tax requirement, and also to use these extensions in time to position zoning so that investors can get a more rapid return and look at California more seriously. Otherwise, I think it's a fairly, in my view, other than some existing projects that were ready to go, it's still a little bit of a sleepy marketplace in California for opportunity zone projects.
Great, thanks, Larry. Paul Hamilton, in real estate, it is said that timing is everything. What should real estate players do now to ensure their viability post-COVID-19?
Boy, to piggyback off of some of the stuff that Larry and Paul said, you know, these retail centers, these malls, they become experiential, right? They become significantly less. You know, we were in a world where retail was 90% of a mall. We need to get to a world where retail is 25, 30%. You really activate outdoors, et cetera. So I think, I personally think it's a little premature right now. I think things are sort of in limbo. So we have for us at least, a wait and see approach. We're seeing some transactions, some properties trading, but generally we feel like there's a gap between the sellers and buyers right now that I think will narrow as we push into Q1. So what we've been doing is just stockpiling money. And we're doing one-off deals, you know, in the industrial sector is expanding because of, you know, basically everyone's like Larry said, everyone's buying things on this. And so, you know, you've got people in search of warehouses for shipping, and you've got Walmart trying to get your parking garage. So we're doing one-off transactions where we feel like it's COVID-proof, recession-proof, where it's just an absolute necessity that this particular transaction be done. But other than that, we're sitting on our hands right now for the most part, waiting for opportunity that we think is going to come.
You know, I know in talking with a lot of business owners, a lot of business owners are trying to work with banks to restructure debt and to, you know, reforecast projections. How willing are banks to work with people and to modify loans for businesses?
Well, it's interesting. You and I, you know, your company and my company own the Sky Chef building at McCarran Airport in Las Vegas. It's the only privately held building on property, and we love that building. It also happens to be one of the few things that we have debt on. And so Sky Chef is the food provider for about 80% of the flights in and out of Las Vegas, which in peak mode, that's a lot of food. And so they've been a great tenant. The mothership for them is a humongous company that is a great guarantor. But the bottom line is Sky Chef came to us, you know, I would say probably 3 months into COVID, and asked if they could defer all or some portion of their rent for 3 to 6 months. And, you know, I called Charles and we sort of talked about it, and we went to the lender, and the lender said, sure. So I think, you know, early on, you're going to see, you know, we're all in this together, right? And even the banks feel like, you know, let's try to do the right thing. So right now, I think for the most part, most of the lenders are being friendly, but there does come a point where the owner starts to struggle and the lender starts to crack down on him, and the owner then turns around and cracks down on the tenant. You start to see these, as Paul said, some of these bankruptcies that were inevitable, but maybe they would have lasted in your space for 5 years instead of now 5 months. And so I think right now we're in that middle area of they're still willing to give consideration. But I think as we push forward, that will go away and will be replaced by more cleansing, so to speak, of tenants, et cetera, and also owners, unfortunately.
Thanks, Paul. Adam Henderson, digital transformation is here to stay. So what role will technology play in the future of commercial real estate?
Well, it's, you know, I mean, the role I have at Keiretsu Forum and seeing what's going on globally, you know, there is just technology coming out just on a constant basis. And I think on the real estate side, I think, you know, Paul talked about AI in relationship to his company and speeding up the process of the work. And really, I think technology started way back when for us, when we were, you know, trying to get LEED certifications on our buildings, and we were looking at green products. And at that time was sort of the beginning of sort of the technology, newer lighting, you know, better management of HVAC and such. And now it's really accelerated to where commercial real estate is really adopting much of the new technology now. And part of that is, in fact, you know, tenants expect a minimum level of technology, you know, at a building. And in order to, you know, get that business, you have to keep up with the neighbors and continue to do that. And that's going to be actually one of the challenges going forward for, sort of the office building sector. Industrial, like Paul Hamilton said, we're the same, very optimistic about that. There's obviously a lot of shifting in the retail sector, and there's a big divide between kind of what you see on Wall Street with these, high market highs and what's going on Main Street. So there's a lot of disconnect in the world right now for, I think, me also, who grew up building a business in a crisis. So a lot of this is left to be played out. And I think that's probably what gives, everybody a little angst, even in their own worlds. It's the uncertainty of the future here and what it looks like, and when do we solve COVID or at least contain it to everybody's satisfaction. So, but really the real estate, because of all of this, the buildings that reopen are having to adopt all the new technologies that are out there, and there's a bunch of them being developed about automatic. You don't touch doorknobs, you don't touch this. We're monitoring when you come in. So many of those things, and really even robot cleaning, of property. So it's already impacted real estate. The future is going to have a significant impact. It's going to look different. But on the production side of real estate, what Paul does and our construction and other things that we do, that's been really one of the beneficial places of technology. On the production end of real estate, technology's had a huge impact. And now, of course, with AI and property tracking, you can do a lot more business all over the world because of technology than we're able to do in the past. So it's going to continue to have a big impact, and the future will be fun to watch.
Okay, thanks, Adam. Paul Martinkovic, this question's for you. Given Journey's extensive background in international development projects, what impact has COVID-19 had on business in Asia, and has it recovered?
Well, we're major exporters, U.S. exporters. So 70% of our work is overseas, mostly in Asia and China. Even before COVID, I was quite worried about all the political bantering going back and forth about trade wars and, that type of thing. When COVID hit and our company was shut down by the city, and the travel stopped, I thought we were in really deep trouble. We did get a PPP loan, but as it turned out, the China clients actually kept calling, and we've been able to do a workaround with the Zoom meetings. It's not optimal. And just recently, they took all our travel visas away, so my visa was taken away. So we're in the process of reapplying for all that. But it hasn't been the disaster I expected. We had a hostile actor take over our IT system 2 weeks after the city shut down. It just everything, I don't know, I can share stories. I'm sure we all can share them about this year has just been a disaster, one thing after another, but we've actually, have done well. We're still trying to recover our, revenue stream that we've lost, but China is pouring a ton of money in their economy. I just don't know where they're getting it. And they're continuing to grow, and, their entitlement program is something that, when they want to get something done, they don't have the property rights that we do here in the US. So getting things done is much faster. So we're still strong. We opened an office in Singapore last year. It's doing very well. Vietnam took a lot of the China sea traffic away. They're doing a lot of resort, residential, that type of thing. So I'm optimistic about the future of our company.
Great. Thanks, Bob. Hey, Larry, this question's for you. Given your extensive background in city management, and just in real estate in general, who are the winners and losers in commercial real estate going forward?
I mean, right now, the applications we're seeing and the projects we're helping are, very early on, large blended use projects. For example, last night, worked on a project with the city of Anaheim, and the Angels did get approval to purchase about 150 acres from the city of Anaheim and keep their stadium there and perhaps build a new one. And that's a large proposed blended use project. So I think, projects that are early in the pipeline are still going to move forward. In terms of existing projects, as I said, a priority for all of the owners, developers, and even tenants is how do you reuse retail? I think industrial is really the leader in this economy because it's a combination of filling in the blanks on urban infill for last mile delivery. And perhaps, we have one slide that's got the picture of an old JCPenney building with Amazon on it, because to us that euphemistically just shows where the transition is going. You will have fulfillment as a product in retail centers because that'll help the retailers on site and it'll help last mile delivery. So industrial and last mile delivery for sure. In California and other places and throughout the country, shortage of housing. So residential, all product types, very, very strong, especially as they get redesigned with new ventilation systems and amenities that are more outdoors and workspaces that actually mirror, what was once provided by a co-working provider, done more in a apartment, a condominium setting. So you'll see that happen. The obstacle to residential will be acceptance at the local level politically, which is what I talked about earlier. The other winners, I think for now, and until sort of the cleanliness theater environment gets a little bit more acknowledged, in other words, hotels will be challenged until the consumer feels they're safe, unless they have to take a trip. So you have uses that are going to be later than sooner, like hotels. Office is just a mix. I think you'll have less density in office, but you still may have the same amount of square footage being activated because enough people will want to use that office space, just less people within that office. We call it the 6-foot office or the 6-foot COVID office. So I think office has a life. It's just going to be restructured a bit, and no one really knows what the absolute equation is for that, but I don't think it's going anywhere. I think it just restructures. So office in the middle, residential and industrial at the leading end of the pack. And I think retail just getting restructured. That's how we sort of rate these things. In terms of residential, the other notion is that there tends to be at this point, because we don't have a vaccine, there tends to be a bias towards suburban development versus urban development at this point. We just see the opportunities for slightly less dense residential in more open, creative office campuses to be attractive as opposed to sort of strict vertical urban projects. Just what we're seeing.
Great. Thanks, Larry. Paul, you have an extensive background in restructuring and saving companies, and I know you did a lot of turnarounds with real estate companies. What services is your company offering at the current time for people who are in need of that service?
Is that for me, Charles?
That's for you, Paul. Yes.
Really, I mean, the service we're offering is really just the top down for any company that, and you can, I mean, anybody on this panel could pick it right now, could just give you, without being in the space at all, could give you 20 companies that are going to fail or are going to have difficulty. This isn't rocket science. So we usually get engaged early on, and sometimes by the creditors, sometimes by the debtors. When it's the creditor, they want us to get in there and tell them unbiased, or give them our unbiased opinion about the business model. Does it have a chance to survive long-term? And if it does, what are the things that need to change? If it's a debtor, it's us doing the same thing, but advising him and trying to keep the wolves at bay in terms of dealing with the lenders, et cetera, while they fix it. And if there's a there, for the company, you can make it through this thing and probably come out a lot better, because now is a good time to restructure your loans, and it's a friendly marketplace for the short-term foreseeable future. But I think that that's going to shift. But like anything else, the businesses should survive, and most often will, and we're helping them do that. And the ones that shouldn't will go away in much faster fashion than would have happened without COVID.
Okay, great. Thanks, Paul. Adam Henderson, this is our last question from my moderated session, and then I'll hand it over to Jason Stubbers and Christine Zhu to take questions from today's attendees. Adam, you built your real estate company with great success during another type of crisis. And although today is unprecedented with COVID-19, are there comparisons, and what's ahead of us?
Yeah, and in fact, this was really, we built the company in the early 90s during the RTC era when, if many recall, that the government took over many of the SNLs, and they called it the SNL crisis. And the Resolution Trust Corporation was formed. And actually the Bass brothers largely acquired many of those banks from the government, and then Richard Rainwater helped them make a fortune carving up the real estate that was a part of some of those SNL debt deals. And so we got very aggressive, bought about 30 plus buildings in about a two-year period. And that bet at the time was, I just left a chief economist from Wells Fargo, Joseph Wahid, at the time. I walked out of a conference in San Francisco, and he told everybody how absolutely horrendous the commercial real estate market was. We couldn't lease up what's available in 20 years. And so within about 5 years, we started to see that cycle change. And then since then, we've had a tremendous run. I mean, it's except for the 08, 09 blip, we ended up, really doing quite well. So our statistics hit us about a year and a half ago. And so we sold a large portion of the portfolio and kind of reset the dials towards what Paul Hamilton was saying. We think there's tremendous opportunity ahead. That crisis was it created a lot of fear and anxiety, and it created actually an opportunity. And so we had capital and deployed it. And this right now still needs to unfold. And so we're being patient and we're looking at this, but it has the same characteristics of fear and anxiety, uncertain about the future, how soon can things turn around? But it was always, for us, we liked what nobody else liked. So we're trying to figure out in the retail sector, alternative asset side, where we like debt. Actually, we had some debt opportunities to help some good projects out that we'll either become partners with or help them through. So in that regard, where we look at, as all of here on the panel, there's always opportunity out there, and it's just sorting through things. But we're going to be patient here because, like you said, it's unprecedented. It's quite new. It's a pandemic-driven issue, and that's something we've never seen to this degree before.
Okay, great. Thanks, Adam. And I would like to personally thank each of you for the time and the commitment. I now will be turning it over to Jason Stubbers and Christine Zhu. But on behalf of the Pepperdine Graziadio Board Real Estate Committee, thank you so much for the time that you spent with me this afternoon.
Thanks, Charles.
Thank you, Charles.
Great. Thank you so much, Charles, and to the panelists. Such a rich dialogue and conversation today. I'd like to introduce Christine Zhu, who is a current MSRE, which is Master of Science in Real Estate grad, and she's going to ask the first two questions today. And then we will move through the remainder of the questions and try to get to as many as possible. And those that we don't get through today, we will try to for those of you who took the time to submit a question. So I'll turn it over to Christine Zhu to ask the first two questions.
Okay, so my first question, I just wanted to know, where do you think construction and development is heading with, you know, construction costs rising, COVID pandemic environment, and older real estate, you know, it's deferred maintenance, rent control, doesn't seem that desirable, just, you know, curious.
Yeah, I'll take a shot at, I think delivery of construction projects at some level is tied to having clear entitlements. So if you have an entitled project and you're ready to construct, then you're going to face, I think, a relatively uncertain financing environment. You know, for the most of the projects that we're looking at, you know, equity requirements increased, debt availability decreased. Yeah, and the cost of capital is historically low, but the risk equation to new construction is pretty high because we have an uncertain market as to what products really will prevail and be successful. So unless you have a slam dunk, you know, mid-density residential project somewhere next to transit in your zone and ready to go, you're probably not going to drive your best lending equation in today's market. But now, that being said, because of that, we're actually seeing municipalities step up and use this low interest rate environment to do lease revenue bonds and other financings that help sort of create a gap resolution for certain projects, because in essence, they would like to see hotel projects come back. They realize it's probably 2 to 3 years before hotels get solid ground and they can't get financing in this marketplace that makes sense, you know, essentially 50% equity deals. So the reality is that some cities are willing to step in and provide a layer of mezzanine financing using a backfill of taxes to be generated by the project. So we see a little bit of that as well. So a lot of uncertainty, a little bit of pricing inconsistency, and a lot of questions as to what really is bankable given where we are.
Thank you. Right. Thank you. And then, so a follow-up question to that, you know, in a competitive market, what are recommendations for investors to approach these, you know, homeowners, these real estate, you know, properties that we want to go after?
Well, Christine, I'll maybe the part of your other question sort of was about, I think, real estate and multifamily and what that environment is. Your screen is frozen on my end, but oh, there you go. But you know, with some of the legislation that's come down to your point, I think it puts a little pressure on. You know, the factor of, you know, people being able to pay their rents and a lot of this in the future, and it looks like we're going to get another stimulus. And this is one of the things that leaves us cautious about knowing what this playing field looks like as investors right now. I think the second stimulus is going to be important really to help Main Street. As I mentioned before, there's a real disconnect between what we're seeing in Wall Street and what we think we're seeing in Main Street. And the employment numbers, you know, got quite frightening, although we're seeing some recovery in there. So it's a cautious time to be looking at all sectors, I would say, with, you know, the exception of industrial. And then I'm getting a lot of questions and interest in investing in self-storage facilities, playing on this sort of shrinking down, moving out of central cities and needing to store things. So anyway, just, you know, a little bit on that, but I think the theme of everything is it's cautious, and we're seeing construction prices actually come down a little bit on some things, but staying steady where construction prices have been sky high and very difficult to actually pencil out with some good projects.
Thank you, Adam. And thank you, Christine, for your two questions. So we have time for a couple more questions and then we'll move into the closing. So the The first question is from Jonah Road. What is going to happen with retail and office space demand? Will work from home provide a long-term negative impact as corporations realize they can take advantage of this potential shift?
I could take a crack at this one. I'm not sure. I think Adam and Larry both touched on this, but I think initially the thought was, in the first couple months, geez, look how effective and efficient we're all being working from home, and if you look out and you say, normally it costs me X millions of dollars a year to house my employees, et cetera. And now I can just give them a stipend and have them work from home or even give them a raise. This seems like a win. And in my initial thought was, this is going to really harm the commercial real estate market. That being said, it's already started to evolve that, people are unhappy at home. People, the employer themselves is unhappy with the result and the production that they're getting from their companies. And so I think on its own, without anybody touching it, what we've seen is an evolution in a very short period of time, call it 6 months, from, boy, when we come out of this, no one's going to need any commercial real estate, to what Larry said earlier, the 6-foot COVID box. You're going to have, maybe you have less people. You do cut out a certain amount of people and let them work from home because it works for them and maybe they're more productive. But you take just as much space because you sort of need it in this new environment that we're living in. And let's just assume for a minute that they do cure COVID. The way that we've all been living, that's not something you just instantaneously turn off. You've developed this sort of, I was watching a movie the other night and there was 10,000 people sitting right next to each other. And I forgot for a minute, and this has only been going on for 6 months, that's how it used to be. And so there is a very strong likelihood that real estate demand remains where it has been and continues to grow. Although, as Adam said, we went to cash about 1.5 years ago because we started to feel like what's more likely, it goes up X or comes down. And so we were doing that either way. But I think that commercial real estate is going to evolve in terms of how it's used, but I don't know that the demand is going to drop long-term over what we've seen historically.
I think the demand's going to shift to different areas, the suburbs. I mean, the idea of a headquarters now is becoming a virtual idea. And, I heard a presenter last week talk about a hub and spoke model for companies where, they'll have little satellite workplaces and so on and so forth. But the idea of everybody coming to a headquarters, I think, as Paul said, we'll work in shifts to accommodate. I mean, people were commuting before COVID 229 hours a year. That's almost a month. I mean, that's crazy, the inefficiency. So I think the demand for real estate will be there. It'll just going to shift to different areas.
My sense is that life is going to be different. There are too many different kinds of companies to actually predict how each of them will respond in a uniform way. I think we'll all make our strategic decisions by category of business and by, the balance of labor and operations that we actually have. I mean, in a company like ours, we are mostly serving lots of different projects and we can do it from anywhere. We actually had become virtual 10 years ago and had invested in software so that we could just, expand our portfolio of projects without having to be trapped by physical premises. And I think a lot of folks are figuring out that some portion of that can work for their operation. People are unhappy because they have school pods as well as jobs in the same, walls. And I think if schools go back, that sentiment shifts back to a more normal response. And if you look at the CEOs in America, they're very divided as to what they're saying. So some are saying, I'll invest in a campus still, and they go buy one. Others are saying, I'd like everybody to work from home, or a good portion of the population to work from home. I don't think there's a clear answer here. I do think that to the extent cities and developers create engaging blended use environments, that will be attractive space, whether it's residential space or it's office space or even it's retail and entertainment space. I think that stuff will be successful. But to predict, the behavior of going back to work versus not, very hard. And I think it's very specific to industries and to size of operation and type of profession, type of company. And that's really the uncertainty that exists in the marketplace.
I would like to take this opportunity to thank everyone today, for Charles for moderating today's session, and for Larry, Paul, Adam, and Paul for being our expert panelists today. Thank you so very much. And for Christine Zhu for helping out with the Q&A session. So at this time, we would like to bid you a farewell for the rest of today and wish you a wonderful rest of your afternoon. And we look forward to seeing you at our upcoming events. So thank you very much and have a wonderful rest of your afternoon.